Scott, chat about notice of intent to claim or vary a deduction for personal super contributions. Scott, don't tell me what to do, but let's chat about it. So chat about notice of intent to claim. So what are we talking about here?
So a notice of intent to claim is a form that's lodged with your super fund. It's letting them know how much you want to claim as a tax deduction in this financial year for a personal superannuation contribution. So these are contributions that you've made from your after-tax wages. It's not through your employer. It's not salary sacrifice. This is money that you have paid and you've put in because you're going to claim a tax deduction for it. So you actually need to tell the super fund what it is that you want to claim for them to be able to approve it effectively.
So I just want to unpack that a little bit. The concessional contribution cap is $30,000 for this financial year. If somebody had, round numbers, their employer put in $15,000 as their normal SG employer contributions, they've got a $15,000 leftover cap of the cap. There's a couple of streets that lead to Rome. They could say, I want a salary sacrifice, $15,000, and that happens each month. And then at the end of the year, they've put $30,000 into super at a 15% contribution if they earn under $250, but keep that aside for now. However, if you are potentially self-employed or you might have an offset account and you're like, I just want to keep cash heavy throughout the year and then I'll make some strategic decisions in June each year, you can then say, okay, it's June to 30th of June, I've got $15,000 cap left over. So what we're saying is you can put that $15,000 of your own money into your super account. Mm-hmm. Then this notice of intent to claim, you log into your super fund probably after the 30th of June and tick the box that I wish to claim personal deductible contributions. That $15,000 has sat in your super account. You tick that box, automatically your super fund will take 15% tax off that. And then your income, if it's $100,000 a year, you will then effectively, your taxable income isn't 100, it's 100 less $15,000 that you've claimed on tax. It could be less $5,000 for some donations. Your taxable income's now $80,000.
Yep, exactly. So it is.
So both way leads to Rome.
Yeah. And like you said, the intention, what do you want to do with that money? How do you want to use it throughout the year? It's a really good strategy if you want to get some extra money into super. And it's also beneficial because you get to claim the tax deduction too.
Overall, between your personal tax file number and the tax in the super fund, for your life, you'll pay less tax overall. Now, we won't touch on it now because it's less about tax, but it's just a flag that you can look back at the last 5 years and see the gaps. So if you had $50,000 cash and you've got $50,000 worth of unused concessional contribution caps, you can, and that's it, I pulled that thread, Erin. If you sold a property that financial year and some cash landed in your bank account, you could theoretically pay $50,000 or more, some of the profit into super, use those concessional contribution caps to release your overall tax position after the capital gains tax for the property outside super.
Perfect. And it is really about looking at, what did I contribute or what has been contributed for me for the last 5 years? And that unused cap, concessional contribution cap is what you can use. So some years it may be, such a random figure like $10,152, and then the next year it's $20,392. So it's very specific, and it's important that you know exactly how much of that unused cap you do have before you make the contributions, because the taxing of it is different. So you want to be able to claim the tax deduction if you've got the cash, but that notice of intent is really important, that it needs to be lodged with the super fund. We can't lodge tax returns until
You've done that.
Until that notice of intent has been done. So it's super important to make sure that it's done, and your accountant will ask for it because they're not supposed to lodge a return until that's been received.
I will flag as well, if you've got HECS or help debt, if you do the salary sacrifice through the year, you'll get a bill at the end of the year because your employer hasn't withheld as much tax based on your overall earnings. So potentially if you do have HECS or help debt, it might be better strategy to add more to super each year at the end of the financial year. Either way, all roads, we go back to Rome. Hello, Rome, what up? Your tax return and your tax file number, like the business and the side hustle, everything comes out in the wash. I always imagine a funnel, everything at the top, it eventually all comes down, the wash up. What did you earn? How much tax do you need to pay?
Exactly. Yep. And these things will help reduce the tax. But if you haven't had enough tax withheld throughout the year because of the salary sacrifice, you will end up with a tax bill because that HECS debt, the help debt, is calculated based on your taxable income. And so it is really important to be mindful of all of these considerations when you're thinking about, well, do I put extra money into super? How much do I need to put? And what is the overall implication on the tax position?
Hey, it's Glen here. Thank you so much for watching today's video. You made it to the end. Can I ask a favor? Can you hit that like button and maybe hit subscribe if you want to get notified when we release further videos just like this one, whether you watch the Money, Money, Money podcast or Retire Right. And remember, if you want to learn more about investing, I've got an investing book, The Quick Start Guide to Investing, and there's a link in the description to get your hands on a copy. Thank you so much. Bye.